Greeting everyone. So in this video, I will be doing question 1 of January 2024 supplementary or Aegrotat exam from Regent Business School. So the name of the program is Bachelor of Commerce in Supply Chain Management, and the module is Accounting Level 1. So we have more details on the paper. So we can see the date here. The paper was written on the 15th of January 2024, and students were given 4 hours to finish the paper. And this paper was out of 100 marks. So I will start with the first question. So question 1. So guys, as you can see here, this question offers 25 marks. Guys, these are a lot of marks, so you can't afford to miss these marks. So before we read the information that is given in this question, let us first go to required. So it's very important to know exactly the requirement of the question. So here we are required to process the above transactions through an accounting equation such as the one shown in the format below. So guys, they want us to do the accounting equation. This is for 12 marks, and we are given the format to follow. So in this format, so we know the formula, the accounting equation formula, assets is equals to equity plus liabilities. So under this asset section, we're going to indicate whether the asset is a non-current or current. And then under equity section, we have the column for capital, which is anything that is contributed by the owner. We're going to record it under this column, capital, contribution made by the owner. And then we have another column for income and expenditure. So guys, we know that income increase owner's equity and expenses decrease owner's equity. So if we have an income, we're going to add because income increase owner's equity. And if we have an expense item, we're going to subtract because expense decrease owner's equity. And then the last column is the liabilities column. So we are required to indicate whether the liability is a non-current or current. So guys, the difference between non-current and current liabilities, we already know that because I explained it during our live lesson, but I will remind you. So guys, I told you that non-current liabilities, those are long-term debts. And then current liabilities, those are short-term debts that are payable within 12 months. So any debt that is payable within 12 months will be disclosed under current liabilities. And then I have prepared the answer book. So we can see here, this is the answer book that I've prepared. We have 1.1 accounting equation. So this is the answer book that we're going to use. So guys, accounting equation can be presented in different formats. So I will also show you this format. So this is another format that you might be required to follow when preparing the accounting equation. So I will show you both formats. So now let us read the information that is given. So we have the list of transactions. So we're gonna read the transactions and record them in the equation. Okay. So the following related to Iron Bender, who started his own panel beating business, Bender's Panel Beaters, on the 1st of July 2023. So the financial year end is 30 June each year. So we have transactions that took place during the month of July 2023. So number 1, Bender deposited 60,000 into the business bank account as his initial capital. So we have the first transaction. Guys, in each and every transaction, you should be able to identify at least 2 accounts that are affected. So when we read this transaction, we can identify that, okay, we've got 2 accounts affected here. So the owner deposited 60,000 into the business bank account. So bank is the first account that is affected. And this is a contribution made by the owner. And we know that any contribution made by the owner is part of what? Of capital. So the second account that is affected is capital. So now we've got 2 accounts that are affected. So guys, I will show you the effect in the T account, and then after we're gonna record on the equation. So we've got T accounts here. So I've already drawn the accounts. So in the first transaction, we have identified 2 accounts that are affected. So we said it's bank account and capital account. So these are 2 accounts that are affected. So now in terms of accounting elements, we know that bank is an asset. So this is an asset. Okay, so bank is an asset. And assets are divided into two categories. We have non-current and current. So bank is an example of a current asset. So this one is a current asset. So it's not a long-term asset. So it's a current short-term asset. And then in terms of debit and credit, all assets increase on the debit side, meaning on the debit side, all assets are positive, and they decrease on the credit side. So on the credit side, all assets are negative. And then another account is capital account. So capital is an equity account. So this one is an equity account. So in terms of debit and credit, all equity accounts increase on the credit side, and they are negative or they decrease on the debit side. So now we have read the transaction. So the owner contributed 60,000 into the business bank account. So now if the owner puts 60,000 to the bank account, what will happen to our bank balance? So our bank balance will increase. Remember, bank is an asset. So all assets increase on the debit side, meaning the 60,000 will be recorded or will be shown on the debit side of bank account, because this is an asset and the balance of our asset bank balance is increasing. So bank account is an asset. So when the asset increases, we record that on the debit side. Now we can apply the double entry rule, double entry principle. So for every debit, there has to be a corresponding credit. So in simple words, we can say if one account is debited, the other one must be credited. So now, since this account, bank account, so since we have debited bank account, it means the contra account should be credited. So the contra account is capital account, because this one, the first account, has been debited, the other one should be credited. So guys, you can't have a situation whereby you debit one account and you also debit you debit the first account and you also debit the second account. You can't do that. If one account is debited, the other one must be credited. So it's double entry principle, meaning the capital account will be credited 60,000. So this 60,000 will be reflected on the credit side of the capital account, which is an equity. So now let us show the effect in the equation. So the first transaction took place on the 1st of July 2023. Okay, so now in this format, we show the account that is debited. So already we have shown that in the T account. So I've shown you in the T account. So the account that is debited is bank account. So bank account is debited and capital account is credited. So the account debited is bank. So bank is an asset. So I will put A. And then the second account that is credited is capital. So capital account is an equity account. So I will put E. And then the column that will be affected here is asset column. So here we have assets column. So this column is affected, and capital is an equity account. So this column will be affected. So liabilities, the column will not be affected. Okay, so now under this column assets, we said our bank balance will increase because of the contribution made by the owner. So now we even, you can, okay, let me use red so that you will see while I'm highlighting here. So you can see here that this account has been debited. So on the debit side, assets are positive. So meaning in the equation, we're going to have plus 60,000. Then the second account that is affected is capital, which is an equity. So we're going to show this under the equity column. So now, as per the T account, the equity has been credited, and on the credit side, equity is positive. So we're going to have another plus 60K. So liabilities is not affected. So we're going to put 0 there. So now this is how we record this in the accounting equation following this format. But now let us use the format that is required in the question. So we're going to provide the date. So this is the format that we are required to follow in the question. So July 2023. 1st of July 2023. So we said the account that is affected is bank account, which is an asset, and bank is a current asset. So under current asset, we're gonna have positive 60,000, and then we have equity section, and under equity section we have capital column. So under capital, because we have the contribution made by the owner, so we're gonna have positive 60,000. So now using this format, this is how we record the effect in the equation. Then next transaction. So this transaction took place on the 2nd of July. Vendor transferred personal equipment valued at 35,000 as additional capital. Remember, every transaction will have two accounts affected. So now let us identify the accounts that are affected here. So the owner transferred equipment. So this is the first account, equipment, which is an asset, long-term asset. So it's an current asset. And this equipment is contributed as part of his capital. So it's additional capital. So the second account affected is capital. So now we have identified two accounts affected, equipment and capital. So now let us show the effect on the T account. So now we can remove this one. So the account affected is equipment account. And equipment is an asset and it's part of long-term assets, non-current. So this one is a non-current assets. Non-current assets. And then, okay, so this is an asset. We know that asset increase on the debit side and decrease on the credit side, so we will not change this one. And then the second account that we have identified is capital account. So I will not remove anything, so I will just change the figure here because the value of equipment that has been contributed by the owner is 35,000. So this 35,000 will be debited because the value of our asset will increase since the business has received an additional equipment from the owner. So the value of our assets will increase. We are now having more assets. So assets always increase on the debit side. Every time when the asset increases, you show that on the debit side. And double entry principle. If one account is debited, the other one must be, if an account is debited, the other one must be credited. So we're going to credit this one for how much? 35,000, the value of the equipment contributed. So now let us record in the equation. So we're going to use this method first. So the date is the 2nd of July 2023 to July 2023. So accounts affected, or the account that is debited is the asset account, which is equipment. So we have debited equipment, which is an asset, and account credited is capital account, which is an equity account. So now two columns that will be affected is the asset and equity column. So now under asset column, we have recorded 35,000 on the debit side. So the 35,000 is recorded or is shown on the debit side, and we know that all assets are positive on the debit side. So we're gonna have plus 35,000. And the capital account has been credited, and on the credit side, all equity accounts are positive. So this one is not affected. Now let us show the effects here. So 2 July. 2023. So we have equipment. So we said equipment is a non-current asset. So under the non-current asset column, we're gonna show the 35,000. So it's positive because we have increased the value of our assets. And then capital has also increased by 35,000. And then we are done. The next one took place. So the next transaction took place on the 3rd of July. Obtained a loan of 100,000 from his cousin. So the owner obtained a loan from the cousin, A. Lackman. So A. Lackman is the name of the cousin who granted the loan to the owner. The loan bears interest at 10% per year and is payable in 2 equal annual installments. The first installment is payable on June 30, 2025, and the second on the 30th of June 2026. Okay, so we have this transaction. So in this transaction, we should identify 2 accounts affected. So I will ignore the interest parts. All right, so the first account that is affected here is loan, and the second account will be bank, obvious, because this loan will be deposited into the bank account of the business. So we have 2 accounts affected, loan and bank. So now we're gonna show effects on the T account. Okay, so the accounts affected, it's gonna be bank, because when the loan is received, the loan is deposited into the bank account. The amount received as a loan will be deposited into the bank account. So hence, we have bank account as one of the accounts affected by the transaction. And the second one is loan account. So loan is a liability. So this one is a liability account. So it is a liability account, and liabilities are divided into current and non-current. So when is this loan payable? Is it payable within 12 months or after 12 months? So if it is payable after 12 months, we will classify it as non-current liability. But if it is payable within 12 months, we will classify it as current liability. So we are told here the loan was taken on the 3rd of July 2023. And the first installment, the first repayment of the loan will be made on the 30th of June 2025. So, this is a long term. So the loan is payable after 12 months. So it's a long-term liability. So in 2024, no capital or no repayment will be made. 2024. We will only start to do the repayment in 2025. That is after 12 months, guys. So any debt that is settled or that is payable after 12 months is classified as a non-current. So if this loan was payable within 12 months, then we would classify it as a current liability, but this one will be a non-current. So it will be shown as a non-current liability. So you already know the reason. So I have explained, I've given the reason. So the reason, it is because this loan is payable after 12 months. So now we are receiving the loan, 100,000. So this 100,000 will be deposited into our bank account, business bank account. So when the money comes into the bank account, what happens to the balance? So the balance increases. So the bank account increases. So 100,000 will be debited. Every time when our assets increases, we show that on the debit side. And then if one account is debited, obviously the other one must be credited. So we're going to credit loan account for how much? 100,000. So this is the effect on the T account. Now let us show the effect in the equation. So this is on the 3rd of July 2023. So the account that is debited is bank, which is an asset. And the account credited is a loan, long-term loan, which is a liability. So bank is debited. So on the debit side, the bank is favorable, is positive, 100,000. And equity is not affected. And the liability has been credited. So when we credit the liability, so now let me show again. So the liability has been credited. So on the credit side, the liability is positive. So we have positive 100,000. And then let us show the effect on the other formats. 3 July 2023. So we have assets section. So under asset section, when I record 100,000 under current, because bank is current assets. So under current assets, we have 100,000, and we are going straight to liabilities section. So we said this loan is payable after 12 months. So it is classified as a non-current long. So it's a non-current, or you can say long-term liability, long-term debts, 100,000. Then we are done. Next transaction. So this one took place on the 4th of July. Purchased new equipment from Bob Squares for how much? 50,000 on credit. So this was acquired on credit. The account will be paid by 5 monthly installments. The first installment is due to be paid on the 31st of August 2023. So now let us identify 2 accounts affected. So we have purchased the equipment, which is an asset. So this is the first account. And how was this equipment purchased? Was it purchased for cash or on credit? So we are told that the equipment was purchased on credit. So we're going to have creditors account. So 2 accounts affected is equipment and creditors account. Or you can say creditors control if you want to. So now we're going to change here. The account that is affected is equipment. So we have acquired the new equipment. And we already know the story of equipment. Equipment is a long-term asset. So it is classified as non-current assets. And then the second account affected is creditors account, because we have acquired or we have purchased the equipment on credit. So we are still owing. So we haven't paid for the equipment. And then creditors account is a liability account. And then now let us read again the terms of repayment. So we are told here that the account will be paid by 5 months installment. So the account is payable within 12 months. So we're going to pay this 50,000 for 5 months. And then after 5 months, the balance will be paid in full. So the balance will be settled in 12 months time. So any debt that is settled within 12 months is classified as what? I've told you guys, it's classified as a current liability. So this one is a current liability account. I mean, it will be classified as a current liability. So it's creditors account and it's classified as a current liability. So now we have acquired equipment. So we will now have more equipment. So the value of our equipment will increase. So we're gonna debit 50,000. Every time when the asset increases, we record that on the credit side. And then if one account is debited, the other one must be credited. So the creditors account will be credited 50,000. So now we're gonna record this in the equation. So the date is the 4th of July 2023. So the account that is debited is equipment. So account debited is equipment. Equipment is an asset. And the account credited is creditor's account or creditor's control. It is a liability. So equipment is debited, and on the debit side, assets are favorable. So we're gonna have plus 50,000. And equity is not affected. So under liabilities, we're gonna have positive 50,000 because on the credit side, liabilities are positive. So now we're gonna show the effect on this format, in this format. So the date is 4 July 23. So the account that is affected is equipment. The first account affected is equipment, and equipment. So it's equipment and equipment. Okay, 1, 2. It is. Okay, sorted. So the first account affected is equipment. So equipment is classified as a non-current asset. So we're gonna have 50,000. It's closed under non-current asset column. And we have creditors, which is classified as a current liability. So we are going straight to current liabilities column, which is closed at 50,000. Then we are sorted. Next transaction. So this one took place on the 5th of July. Paid 4,500 as rent for July 2023. Payment was made by means of an electronic fund transfer to the landlord, the owner of the premises. So guys, we are renting the premises here. So we are paying the rent every month. So the monthly rental is 4.5. So now let us identify two accounts affected. So obvious would be rent expense, and we are making the payment. So when we are making the payment by means of EFT, bank will be affected. So now our bank balance will be reduced because funds are going out. So we are the ones who are making the payment. We are not receiving cash, but we are paying cash to the landlord. So we have transferred using EFT. So our bank balance will be affected. So the two accounts affected is bank and rent expense. So now let us show the effects on the T account. So the first account affected is bank, and we know that bank is the current assets. It's classified as current assets. So bank account is classified as current assets. And then the second account affected is rent expense. Rent expense account. So this one is an expense account. This one is an expense account. And in terms of debit and credit, expenses increase on the debit side. So now we are changing here because now this is the expense account. So expenses increase on the debit side and decrease on the credit side. So guys, we have made the payment. So when we make the payment, our bank balance will be reduced. So we're gonna show the effect on the credit side. So we have made the payment of 4.5 to the landlord for the month of July. So we have transferred the 4.5. So this 4.5 will be reduced. It's gonna reduce our bank balance. So it's credited to our bank account. And then double entry principle. If one account is credited, obvious, the other one must be debited. So this one will be debited 4.5. So we are recognizing the expense incurred. So now let us show the effect in the equation. The date is the 5th of July 2023. So the account debited is expense. So now the account debited is expense, rent expense account. So rent expense account has been debited and bank account has been credited, 4.5. So the account debited is expense, rent expense. This one is an expense account. And the account credited is bank, which is an asset. So now, under assets column, we're gonna have negative. Remember, on the credit side, assets are negative. So this asset account is credited, and on the credit side, all assets are negative. So we're gonna have negative 4.5. And then, guys, there is this principle that I mentioned earlier on concerning income and expenses. So I told you that income accounts increase the value of equity, but expenses reduces the value of equity. I mean, so now under equity we're gonna have negative 4.5 because this is an expense. So all expense account reduces the value of equity. So I hope you are following. So we're gonna put 0 on liabilities because this column is not affected. And then let us show it in this other format. The transaction date is the 5th of July 23. So accounts affected is bank and rent expense. So bank is classified as current liability. So in this case, money is going out, so it's an outflow of cash. So bank is reduced by 4.5, the payment that we are making. And this is an expense. So under equity section, we have this column, the income and expense. So this is an expense. So all expense reduces the value of equity. So we put negative 4.5. Then we almost done. Then the last one. So guys, this is the last one. I hope so far you are all following. So this one took place on the 10th of July. A client made a direct deposit of 11,420 for services rendered. So the client is paying us. So we are receiving 11,420 from the client. Obvious, bank account will be affected here. Is one of the account affected. And this is an income for service rendered. So this is an income account. So two accounts affected is bank and service fee, which is an income account. So we have bank and the second account will be service fee income, service fee account. So this is an income account. So in terms of debit and credit, all income account increase on the credit side and decrease on the debit side. So here we are receiving 11,420 from the client. So this was deposited by the client into the business bank account. So our bank balance will increase because we have received this amount, 11,420. So we're gonna debit 11,420. So the amount received from the client. So if one account is debited, the other one must be credited, 11,420. So now we're gonna show this in the equation. So we are showing this in the equation. The date is the 10th July 2023. So the account debited in this case is bank. So we have debited bank account, and the account credited is fee income, service fee, which is an income account. So under assets column, we're gonna have positive. Remember, bank is debited and bank is an asset. All assets are positive on the debit side. So bank is debited, so we're gonna have positive 11 for 20. And service fee. So this is an income account. Remember the principle: income increase the value of equity, and expenses reduce the value of equity. So this is an income account. So it will increase the value of equity. So under equity, we're gonna add 11 for 20, and this column is not affected. So we are done. Let us, it seems like I don't have space, so I will put it here. So the date is the 10th of July 2023. So bank is classified as current asset. So we are going to current asset column. We add 11 or 20. And then owner's equity section, we have an income account. Service fee is an income account. So income increases the value of equity. So we add 11 for 20. So guys, this is how we prepare the equation, accounting equation. So now you can now then check if your equation is balancing. So because your equation should balance. So how do you check if you have prepared your equation correctly? So now we're gonna add all the balances that we have under asset column. So we have positive 60,000, positive 35,000, positive 100,000, positive 50,000, negative 4.5, and positive 11 for 20. So the value of assets amounts to 251,920. 251,920. So this is the value, total value of our assets. And then now we're going to add the value of equity. We do the same. We have positive 60,000, positive 35,000, negative 4.5, and positive 11 for 20. So the value of equity is 101,920. 101,920. Then the value of liabilities is 150. 100 plus 50, that is 150. The left hand side should equal to right hand side to check if our equation balances. So now we're gonna add 101,920 and 150. So this should give us 251,920. You can see that indeed our left hand side is equal to our right hand side. So if we combine equity and liabilities, we are getting the same balance of 251,920, which is the asset balance. So I hope you are following. So guys, if you have any question, feel free to ask, and I hope that this session has really helped you. So if you are struggling with the accounting equation, I promise after this video, after watching this video, you will no longer have any issues. So thank you for your time and enjoy.